It's been 50 years since today's $18 Big Mac was 65 cents, and there are a lot of similarities between today's economy and the one from 1974. Thanks for joining us here on Wealthium. I'm your host, Andrew Brill, and we'll dive into that right now. Our mission here at Wealthion is to help all of us keep and grow our money. Through interviews with our experts, we'll break down economic trends, markets, and investments. But Wealthion's not just a channel, it's a conversation with our community. So please keep the feedback coming. If there's something you'd like us to talk about or someone you'd like to hear from, let us know. And if you could like and subscribe to the channel, we would really appreciate it. I'd like to introduce you to and welcome Brett Rentmeester from Winrock Wealth Advisors. Wealthion has partnered with Brett and Winrock, so when you ask to speak to a registered investment advisor, it's Brett or one of his partners that'll be reaching out. Brett, thanks so much for joining us.
Thanks for having me, Andrew.
So, Brett, you've written a newsletter, Echoes of 1974, and it's fascinating. Everyone should give it a read. You can find it at winrockwealth.com. So you're saying history repeats itself.
Yeah, well, at least rhymes, as they say, right?
Yeah. So you wrote this article about 1974, and after reading it, I realized that we're in a similar situation today than we were back then. What made you look back 50 years and say, you know what, I'm going to write an article about 1974? This isn't George Orwell type of thing, but it's 1974 versus today.
That's right. Well, truth be told, I turned 50 this year and was born in 1974. So like so many of us do, we sometimes pause and look at the world today versus the world we grew up in or were born into, especially those of us with children, and have to explain to them in our day, we had 3 television channels and, all the differences. And yet, as much as the world was different back then, it dawned on me that there's a fair amount of similarities and things to pay attention to that are maybe cyclical, maybe not exactly repeating, but cyclical, that I think are worth thinking about. In what ways hasn't the world changed? Or what are some of the things that we should be thinking about that might have been a lesson we learned 50 years ago and is kind of outside of the collective consciousness at the moment?
So we're living in today's world. So take me back to 1974 and what the economy was like and what inflation was like and interest rates back then. Because everything was, I know inflation was high, interest rates were high, and we were trying to get a handle on it all.
That's right. And the 70s were a complicated decade. And I think most scholars look back and want to just kind of write it off because it was thought of as a high inflation, low growth, so-called stagflation, stagnant economy with inflation, period. But the reality is, like we're discussing today, things are cyclical and not a linear, pattern. So it's not as if the 70s were just about inflation. The reality is the 70s started with inflation as people got, concerned about the spending, social spending, plus the Vietnam War, et cetera. And by 1974, inflation was really rearing its head, much like we experienced last year. And that was a concern. But right around 1973 and 1974, a pretty damaging recession took hold and pulled everything down. Inflation and interest rates came back down, but not as low as they had been. So kind of a higher low. And I think probably at the time there was a general thinking of like, we got through that without inflation soaring. But what it set the stage of with the same behavior going forward was a second wave of all of these problems that we all think of when we think of the 70s. We think of, the inflation rate that got to near 14% and short-term interest rates that peaked at, depending how you measure it, about 16.5%. All of that happened at the end of the 70s into the 80s. And so a question on the table is, are there similarities to 2024 relative to 1974? And what does lie ahead?
So I would assume the Fed is trying to avoid the 74 to 80 trajectory that you're talking about. And look, just Tuesday, the CPI came out and inflation's still over 3%. If you take out the core stuff, food and energy, we're still over 4% or right around 4%. So it looks like the Fed might even push off. We know they're pushing off a March cut. I mean, I think that's baked in the cake there. Probably not in May, but we'll have to, obviously the numbers will have to bear that out. But do you think the Fed is trying to look back at that time, or not really look back, but think about, look, you know what, we don't want to get into a position where we start to drop rates and everything goes haywire again?
Yeah, I think they certainly know some of the lessons from it. I think the fundamental difference between the 70s and today is that we have so much debt. And, it's not just the 34 trillion acknowledged official debt. It's all the unfunded liabilities that, some people will come up to a present value, what you need today of a couple hundred trillion. It's just a staggering amounts of debt. So they almost, they can't get they can't get things in the predicament where rates run away from them, or they wouldn't like to see that, because that kind of blows up the system at some point. But they're a little bit stuck here because inflation's here, and whether or not they raise rates next meeting, et cetera, is less important than just looking at the trajectory of where not only the US, but where Europe, Japan, all the developed countries, seemingly to me, have too much debt. And not only that, but they're spending above and beyond that. There's no change in behavior. There's no budget in the US right now. It seems obvious to me that we're going to run into trouble at some point with that kind of forward-looking thinking.
Explain to us how that works. $34 trillion. It's gone up, I guess, in the last month, another $1 trillion. We have to finance this debt somehow. And with interest rates to where they are, you explain in the article that someone's going to buy that debt, but it's going to cost our country a lot of money to finance that debt.
That's absolutely right, Andrew. And, the shocking thing as we enter 2024 is there's been little talk about that, but the numbers we've seen have estimates somewhere in the neighborhood of a $2 trillion deficit. That means you've got to issue bonds to cover the shortfall of $2 trillion. And then we've got upwards of another $8 trillion of existing debt that's going to mature and have to be refinanced. So together, that's $10 trillion. It's roughly a third of our official debt that has to come to market. And we've got that at a time when rates are already much higher than they have been, and at a time where a number of countries are starting to move away from the US dollar, or at least look at alternatives. So, as I've always said, you're going to find a buyer. Argentina finds buyers for its bonds, but at what price? And that's the unknown. That should, all else equal, keep rates higher than they'd normally be in this kind of predicament.
So volatility is a major concern here, where we see we see it coming, inflation coming down, but we don't want it to spike. But there's all these factors that are weighing. We see, economic data come out, the market goes down 600-700 points. We may be fickle, and maybe tomorrow it goes back up a couple hundred points. But there's that that rise and fall. How does an investor, like, I don't have a strong stomach.
Yeah.
How does an investor, or our viewers, protect themselves against all these waves and peaks and valleys?
Yeah, it's a great question. I think, listen, the conventional view has been that a stock and bond balanced portfolio get you through the ups and downs. And that's worked very well since the 70s. But since the 70s, we've been in one kind of period, and that is a period where interest rates have been coming down, and that force lifts all asset values, stocks and bonds. Now we're at a little more of an inflection point. And I think going forward, the more conventional stock and bond mix is going to be challenged, where they both run into trouble, stocks and bonds, oftentimes is in a rising interest rate environment or one with high inflation. What tends to do well in high inflation? If you use the 70s as a lesson, hard assets, tangible things that can't be printed out of thin air, tend to go up in value if governments are irresponsibly, printing money and being careless. And so, just speaking to what happened in the 70s, we know oil and gas were up tremendously. We know real estate was up. We know farmland was up. Pretty much take any hard asset with a somewhat limited supply, and those are the things that did very well. So I think for today's investor, the general guidance is you kind of need one foot in the old world, which is stocks, bonds, conventional things, but you need a foot in the world that says, we might be at this inflection point, and we've got to think a little bit different about the risks ahead of us than maybe the last 20, 30, even 40 years.
I was reading that you had talked about fuel prices were up high, food prices are up high. Now we're at the point again where food prices are high, housing prices are high, but energy costs are low. Is this an anomaly?
Yeah, I mean, a little bit. Some of these markets are hard to explain. I mean, we had been not in energy markets until COVID. And when COVID hit, you might remember the day where the print of oil went negative. We became buyers of energy. So that didn't make any sense to us either. So the world is going through some gyrations, but I think energy, having some energy exposure is a good hedge. Energy has always done well during periods of geopolitical conflict and turmoil, and we've got another war of unknown consequences brewing in the Middle East. So it's harder to map out than some asset prices, but I think yeah, it's something that ought to be considered at a high level.
Something that I really enjoyed from the article is looking at McDonald's when you talk about food prices that are going up, and the price of a Big Mac. There was just an article the other day. There's places in this country where the Big Mac is $18. Now
Right.
that to me is not fast food. That is a lot of money for a burger, especially McDonald's. But back in the 70s, the Big Mac was 65 cents. A large fries was 46 cents. So you add that up, $1.10, throw in a drink, you're talking about a buck and a quarter for a meal that just the burger now is going to cost you 18 bucks.
That's right. And we all see it. We all see it, right? You go to a nice restaurant and the hamburger is now what the steak used to be. And I think that's why investors are nervous, because no matter how much money you have or how prudent you've been, the money's just not going as far. And when we talk about inflation, that's a rate of change. It's not like prices have come down. The rate of growth may slow a bit from where it was. Doesn't mean prices are coming down, at least in the things you need. So I think that's likely to be a more permanent fixture of the kind of backdrop we have to deal with in the next decade.
Yeah, that was something else I was reading is that services are going up. They continue to rise while cost of certain goods are actually coming down.
Yeah. I mean, I like the saying everything you need is going up in price, and everything in the discretionary things maybe you don't care much about, they're going down. I mean, some technology stuff will keep coming down, but you're right. I mean, just speaking as a business owner, whether you're looking at your annual insurance growth rate or all these services, accounting, legal, I mean, it's just on a continued upward trend. So again, I think that's more of the reality of the backdrop we're going to face.
And I'm certainly no expert. Do you see the Fed trying to get? Obviously, they're trying to keep it things and not have inflation come down. Do you see some sort of cuts coming towards the end of the year?
It cuts as far as interest rates.
Yeah,
Well, I mean, to be perfectly honest, I think what we've created is kind of a bubble making machine where times get tough. We print a bunch of money out of thin air. We jam it into the system. It has an effect. It lifts the tide, and then things start waning. And the Fed stays there, kind of where we're at today, not wanting to do too much. But inevitably, that breaks, and they panic, and they come in and they do it again. So I think the next time we're truly going to see um, at least a big printing of money and a big push to perhaps bring the cost of capital down is in the face of a crisis, which, whether one's upon us now or something's out there on the horizon in a year or two, I think, I think that is the playbook and that's what we should expect. But I don't think that happens until such time that there's a big enough crisis that forces their hand or an exogenous event where they can say, well, it had nothing to do with our policies. It was this thing over here that we couldn't have foreseen, to take the blame off of policy.
your next lesson, Brett, in the article is about extreme stock valuations, and it's interesting that we used to have the Nifty 50 back in the 70s, and now we have a very much a smaller amount of stocks that are really holding up the S&P, the Magnificent Seven,
That's
and
right.
talk to us about what people were thinking about the Nifty 50. I know you did a ton of research about this stuff. What were people thinking about then? Because it was a more diverse group of stocks. I mean, 50 stocks, not all in the same sector. The seven stocks we're talking about now are all in the tech sector.
That's right. That's right. Yeah, I would say, anytime the market's being dominated by a smaller and smaller group of companies, the more dangerous it is in some respects. So today is an extreme, seven companies driving everything. But back then, even 50, so seven companies is about 1% plus or minus of the S&P 500 are pretty much dictating the pace. And plenty of people have done analysis that if you take the market cap weighting out and you make it an equal weighted index, you really didn't have much gain at all in the S&P. And you look at that relative to international stocks, emerging market stocks, they haven't benefited from the gain. So it's kind of been the only game in town. But like the 70s, I think the lesson is, or the tech bubble, that no matter what the promise of some of these companies, and in the 70s, it was great growth names like McDonald's, like Avon, like some of the pharmaceutical companies, those were the growth engines of the time. And there was a general thinking that it was a buy and hold decision. Just buy this basket and don't worry about it. And of course, when the last guy did that is when they corrected 50 to 80%. So not suggesting that's imminent for us, but I think anytime a market's being driven by fewer and fewer stocks, especially in the world we're in, where a lot of the investors are not people like you and I, Andrew. These are algorithmic traders chasing things with no loyalty to the long-term performance. They'll be in and out, before we react. It's a more dangerous fact pattern.
Yeah. So back in 1974, if somebody, say at the age of 30, were to have money in the market, you probably would have said to them, you know what, don't worry about it. It's cyclical. It's going to come back. May take 10, 20 years. You have that time. But we have people that don't have that time now. They're of retirement age or thinking about retirement. What do those people do? Because there's got to be a correction coming at some point, I would assume. I'm no economist and I'm no, master at the market, but I have to assume that there's at some point people are going to say, AI, okay, it ran its course. It's still great, but these stocks are way overvalued. How do I protect myself from my retirement savings going off a cliff?
Yeah, that's right. And listen, even for young investors, I've actually never bought into the idea that just because you're 25 or 30, you should just take risks no matter what. I think there are a lot of markets, there aren't clear warning, red lights flashing. But I think when you get to more extreme valuations, even aggressive investors ought to take heed. And, for people that don't have time to recover from losses, you're right. I think you have to really think about your equity exposure, not only the overall size of the allocation, but what underlying names you've got and whether you're taking profit along the way or you're letting a position just get bigger and bigger. I think those are the type of investors that have to do a real risk analysis at this kind of juncture.
What are the risks of these way over valuations? I know that, look, we went through it with the dot-com bubble and everybody's like, oh my God, this is the greatest thing since sliced bread. But these valuations seem to be high. Look, 10 years from now, we could be looking at this and say, those valuations were way too low. But right now, what are the risks of, these 6 or 7 stocks, being valued the way they are?
Yeah, well, they're big. I mean, we only have to go back a year. I mean, 2023 was a rebound year from 2022. The NASDAQ, I think, lost 35 or so percent. And the NVIDIAs of the world and the leaders that everybody's in love with today lost half their value. So we've seen it real time. It's just we've got such a short-term orientation here, especially in the West, where you take that hit and tomorrow it's forgotten about. So, yeah, I think, honestly, one of my biggest lessons when I first started my career was the tech bubble. And I remember as an investor buying EMC, which was data storage. And every projection into the future was data is going to keep growing. They're the leader of storage. And it did keep growing. And they were the leader of storage. And they still fell 90% and didn't recover. So, valuations can get so far ahead of what a company can deliver that these are great companies. And there's no question some of this AI stuff will be extremely disruptive. But the question is, are we in a hype cycle first where things go too far, too fast, correct? And then you want to be there to pick up the bargains or not.
Yeah, GameStop comes to mind where the hype, and all of a sudden, right, that fell off a cliff. I don't think, maybe we're hyping AI and it's so new that everybody's like, oh, I have to get in. And we're going to see probably more IPOs, even that they're coming back into play on companies that have AI that are thinking, what, we're going to try and raise money to really grow our company. That's right.
And listen, you're in media, you remember the internet revolution. I mean, it wasn't like everything just did well. It was very disruptive. There were winners and losers. some industries got totally gutted out by the internet. So I think with AI, you're going to see something similar, that AI is going to replace a lot of the middlemen, a lot of the things that don't require a skill beyond following steps from, I don't know, you could say the legal profession has some risks, CPAs and tax accounting, go down the list, but it's disruptive. So there will be pain in the economy to get to a better point where these tools are working and people find other roles or enhanced roles in the same value chain. So it's not as if we just jump from here to there and everything's great and it solved all the problems of the world.
Yeah, I heard something funny that said AI isn't going to replace people; it's only going to replace the people who don't know how to use it. So
Yeah, right.
it's we're all actually gonna have to figure out how to use it sooner or later, because it's going to become part of our like our everything you do is connected to AI now. So it's
Absolutely.
the algorithms are just there. So I don't want to get into any political discussion, but part of your article talks about political instability. Back in 1974, we had a president that resigned,
Right.
and a country that, let's just say, they weren't too happy with our country at that point. We're in a similar spot now, aren't we?
I think we are. I think we are, Andrew. And, these things go in cycles. But in the West, our whole system is based on faith and confidence. Faith and confidence in what? Your elected officials, the financial institutions, the decision making. And I think there's a lot of discontent. And it's not just on one side of the aisle or the other. It's a general question of, we're living well beyond our means. We're spending money seemingly in every direction. And it is a question of faith. And there are big thinkers like author I like, Neil Howe, in The Fourth Turning, that have a cyclical view of history that say at a fourth turning about every 100 years, and his timeline's about now, people start losing faith in the institutions that served prior generations well. And they just don't work anymore. So whether you want to talk about Social Security really running out of money, or the FDIC really having not much relative to what claims could be, I mean, these old institutions that were put into place 50 to 100 years ago have served us well, but we might be evolving beyond some of that. And I think loss of faith means maybe a tearing down of some of the old, and that will be painful, but a rebuilding to a better spot, hopefully, that's more in line with where we're headed.
Talk to me about how this is an election year. How does that play into markets and how people invest, if at all?
Yeah, it's a great question, because there's a common belief, and I think it's statistically proven that, hey, the Fed's kind of accommodative going into an election year, and markets are good. And I think the averages probably prove that out. However, there's some huge exceptions to that. 2020, it's election year, and that was COVID, right? 08, election year, great financial crisis. Before that, election year during the tech bubble. So it's kind of like someone saying to you, yeah, on average, things will be good, but if they're not good, they tend to be really bad. I don't know. I think this is it's a different kind of environment than we've seen. It's more polarized. It's more charged up. And I don't know. I think there's more caution warranted than kind of a normal cycle.
Yeah, given the economy, I know the economy it's a big political talking point, and I guess you can spin the economy however you want when you're a
Right.
politician. Say, oh, you know what, things are terrible under Biden, and then Biden's going to say, well, I inherited something terrible, and look what I did. So that's definitely used as the economy. I guess you can spin it any way you want if you're a politician.
Yeah, you can. And ultimately, all the data has gotten so much more complex. Like GDP includes government spending. So if we hadn't spent trillions of dollars, would the numbers look good? I don't know. Earnings were pretty weak last year outside of the big tech. So were earnings great? I don't, it is harder to decipher and work through that. So I think you're right. You can tell a tale either direction right now.
So we talk about politics. You touched on global conflict, and that's one of your lessons from 1974. And back in the early 70s, we were, there was plenty of conflict. The Vietnam War was going on. There was a lot of geopolitical stuff happening. And we're right back there again today. I mean, you talked about the Yom Kippur War in your article, and the day after that, 50 years later, was the invasion of Israel by Hamas. So, how does global conflict and geopolitical things affect the economies?
Yeah. Well, listen, I think we'd be naive if we said war is good, right? And we're destroying lives and buildings and other things. But, the markets kind of brushed past a lot of the prior conflicts. I think this time around, it's a little different. I think, a number of countries have debts that can't be serviced as rates go up. And war is a convenient excuse to tear up all those obligations and reset the rules and say, again, hey, it wasn't us, it was this. That's why we had to change the program, not pay you back, et cetera. So we're watching it carefully. I mean, certainly we don't have any crystal ball. But I think anytime you've got major powers all in a dangerous spot, it's something to keep an eye on. All the world wars, they took time to develop. There were facts and patterns when you look back before the big events that, looking back in time, you could recognize as trigger events. So, we're looking for things like that, but it's not good.
Yeah. And there's a lot of countries around the world whose economies are in far worse shape than ours. As a matter of fact, our economy looks great compared to theirs. How does that affect the U.S. economy, and how does the world economy affect everything that goes on here and around the world?
Well, obviously, we're all much more integrated now. So when China goes into a major slowdown, you have to ask the question of, is it because they're the manufacturing floor of the world? Is it because orders are down, or is it something unique to China? Or, if we create another credit bubble in the U.S., like has happened with housing and other things in the past, and that collapses, that spills over to the rest of the world. So, I mean, we're interconnected, and yes, we've done better on paper, but we've also had the benefit of the printing press, the ability to kind of print money out of thin air until recently, without outright inflation that was troublesome. So the real question is, are we going to get ourselves in a predicament where that's not the case, where we can't just print money out of thin air to get ourselves out of the next trouble spot, especially with these BRICS countries and other people starting to pull back and rethink the idea that everything's got to go through the dollar system.
Which brings us to our next lesson in the article is currency. And you make the point of currency kind of evolving for 100 years and then kind of changing. Now, we saw it with the euro, I guess, back in right around 1999, 2000. And now we're cryptocurrency is becoming
Right.
the buzzword, and we see Bitcoin jumping near 50,000. And, are we at a point where the dollar could be changing?
Yeah, and I think you're referring to, we looked back, and other people have done this work to see that, the British currency was before us, and prior to that, it was Spain and Portugal, and they all had about a 100-year reign as being the reserve currency used around the world. And they didn't go away after that. People are still using those currencies, but they pulled back. So the question is, where are we in the life cycle of the dollar? And it seems like we're at a point where bigger events are starting to happen. Now, is there an heir apparent? No, because all of the other countries, you mentioned the euro, the yen, the Chinese yuan, they all have major issues. They all are indebted, they're printing too much money. So this is kind of a global issue right now on currencies. And it may be a different kind of path. I think in the past, there might have been a new currency to jump to in the fiat currency world. I don't think that's going to be the case. I think it's going to be more binary. One path might be, hey, they just can't make obligations anymore. And the centralized powers seem to want to take us to the central bank digital currency, CBDC world, which is not cryptocurrencies. That's a controlled, programmable money kind of future that maybe they can do something different with. And free markets are starting to take us more towards maybe gold and silver. I heard Zimbabwe, I don't know if it's true, is looking at gold-backed currency. We have other countries that are openly endorsing Bitcoin, from El Salvador to other countries that have gotten friendlier towards it. So I think the free markets are saying, give me something that can't be printed out of thin air. Could be gold and silver, could be Bitcoin, could be other things, but they're recognizing that the problem today is squarely on the side of governments just outspending any reasonable levels. So we'll see.
Is this a good time to get? You talk about gold and silver. I know gold price was down a little bit on Tuesday, but is this a good time to get into that sort of thing? Because that could protect you a little bit from the volatility of the market, even though gold prices can be slightly volatile, but gold prices seem to always go up.
Yeah, and I think gold and silver are a patience trade. They're going to protect your purchasing power. So back to the McDonald's example, a silver coin today or a gold coin buys you about the same McDonald's. We use McDonald's stuff today versus 1970 versus if McDonald's was there in 1900. So it's a purchasing power play. And it's for people that are just getting concerned. So the old answer might have been, I'll just have all my money in bonds. I'll move to be more defensive. But now there's a real concern not only about inflation and what that does to bond purchasing power, but also to, I don't know, our government's going to pay me back. I know some of the studies in the Great Depression where people got paid back ultimately, but there were periods where interest was frozen and they got it many years later. So a lot of people are reliant on money today. I think in a world where the problem is too much debt and printed money, yes, physical gold and silver play a very fundamental role in just protecting wealth.
And how can investors balance their need for growth opportunities? Obviously, gold, silver might be one of them with, stability and risk management.
Yeah, I think it's thinking through an entire portfolio. And again, I guess the comment I'd make is a lot of advisors are still what I'd say investing like it was 20 years ago. It's the stock and bond mix with maybe an occasional hedge fund or something. And, if they don't like stocks, they're going to go from 75% to 70%, like small little moves. I think realistically, you've got to make bigger moves when the data suggests it. So, when interest rates went to 0%, we weren't sitting there in tons of bonds. But now that short rates are at 5.5%, we've moved more money to clipping that safe coupon as an example. So I think it's about balancing out a portfolio, but going beyond stocks and bonds. And that can include hard assets. It can also include private investments that are more readily available, ranging from the right kind of private real estate to the right type of private equity. I mean, personally, I'd rather be in the private markets playing the AI kind of themes than chasing something at a 35 times sales multiple. It's not that you can't take any risk. We're always in a world where you've got to take calculated risk. But I think there are times where there are warning signs where even if you're the most aggressive investor, you dial that back and you put yourself in a position where if things do fall, you can actually play offense. And that's not investor psychology. Investor psychology is to chase when everything's running. Or as Warren Buffett said, you want to be fearful when other people are greedy. Are other people greedy right now? It seems like it. It seems like we're closer to that than not.
So talk to me a little about Winrock. You're our new registered investment advisors. Talk to me a little about your philosophy and how you can help our viewers.
Yeah, thank you. And we're thrilled to have a partnership with Wealthion. Very excited about it. I think we bring a different flavor to the wealth management space, quite honestly. And there's a lot of good advisors out there, don't get me wrong. But a lot of them are set in that kind of conventional mindset and building portfolios with data that was optimized post-World War II. And I just think that misses a lot of where we're headed. So I'd say the two unique attributes about us, other than being an experienced, dedicated team of utmost client service, is that we're willing to have more of a discerning macroeconomic point of view, but only at times where there's really an anomaly. So in other words, we went into COVID, believe it or not, very cautious, and we got very aggressive when COVID hit. And then we've been harvesting gains since, and we're cautious right now. So that's not how every advisor works. Most kind of stick in, like I said, the stock bond mix, maybe 5% here or there will move. So I think a little more of a macroeconomic point of view and positioning based on that, and combining that with a more of an entrepreneurial mindset. And that doesn't mean risk taking. In fact, I think entrepreneurs are very savvy risk return kind of thinkers. So what does that mean? It means, hey, we were early cryptocurrency investors. We were early in, a concept in real estate considered build to rent, where you're building communities that are, they look like little single family homes, but they're rented out. And they're trying to meet the need for the fact that it's very unaffordable in some of these key markets to buy your first time home. So, a little more of an entrepreneurial mindset is what you tend to see with bigger investors, these so-called family offices or billionaires. They like private deals. They like to do interesting niche things that are harder for advisors to do. So we're trying to put a little more of a macroeconomic flavor on what we're doing and combine it with some really interesting bottom-up private opportunities that aren't as typical.
So that's what you get with Winrock. Brett, where can people find you on social media?
Well, that's a great question. I mean, we're on Twitter. I think the best place, honestly, right now is to go to our website, winrockwealth.com. But we're on LinkedIn, Twitter, and other sources as well.
Well, Brett, thanks so much for joining me. I hope everyone gets a chance to read the newsletter. That's a wrap on another discussion here on Wealthion. Thanks again for joining us. If you need help being financially resilient, please head over to wealthion.com. Sign up for a free no-obligation consultation from our vetted registered investment advisors. That would be Brett and Winrock. And remember to follow us on social media for the latest news and information to help you invest wisely. Thank you for watching, and until next time, stay informed, stay empowered, and may your investments flourish.